Okay, now this is for postal service workers and FEGLI, and as you look at this chart, you'll begin to understand it more. And the more that you listen to this explanation, the more you will begin to understand why it's important to go for the net zero cost coverage versus the typical FEGLI coverage. So just listen to, kind of how I go through this. I just got done going through this with a postal service worker. So everything's already highlighted. It's laid out, very easy to understand. All right, so we're going to run this hypothetical scenario just because it was exactly the scenario that I went through with the postal service worker, but a 35-year-old female postal worker in the state of Arizona, non-smoker, in fairly good health. Okay, so as most postal service workers do, she has a 5 times her annual salary life insurance amount. So let's just go ahead and say her annual salary right now as a 35-year-old is 55,000 per year. So 5 times that amount is 275,000. So she has 275,000 of coverage, and which she's paying 3 cents biweekly, which is per paycheck per thousand. So 275 times 3 cents. Okay. And during the time that she's in this age bracket, which is 5 years, so each age bracket is 5 years, okay, she will spend $1,072.50. And then the next age bracket is age 40 to 44. It goes up to 4 cents per thousand. So in that age bracket, for the time that she's in there, she'll pay $1,430. Now, when she turns 45, we're just going to run the simplified numbers and say hypothetically she only has a pay raise in that 10-year gap of 5,000 per year, which obviously we both know, or all of us know, that it's probably going to be a lot higher than that. But for simplicity's sake, let's say it's 60,000. She's paying 7 cents per thousand. So in that age bracket, 5-year period of time, she's going to be paying $2,730. Now, age bracket number 5, so on and so forth, till she gets down here. Age group number 6, age 50 through 59. Let's say now she's making 65,000 a year. Okay, multiply. Now she's at 20 cents per thousand, which is almost 10 times where we started. So now in this 5-year span, she's going to be paying 8,450. And then finally, in the last age bracket, because we're going to say that she's retiring at age 65, so she won't hit that point. She's just going to retire on her 65th birthday, hypothetically. 44 cents per thousand. So in that 5-year span, she'll pay 18,590. In this entirety of her career, she will pay $36,562.50. Now, again, this is assuming that her last 10 years that she's working, she's only making 65,000. Obviously, that's not going to be the case. We just did that for simplicity. But if she was making 75,000 or 80,000, obviously these last numbers here, or all through the last 2 decades of her career, would be a lot higher. So very, very conservative number here, just lowballing it, okay? But if you look at this through the 30-year time span, how much would you have to pay per month to actually get to 36,000? Well, it's about $103 every single month. So if you start at age 35 all the way to 65 and you paid $103 about, then you'd come up with 36,562. So as a postal service worker, what happens when you decide to retire at age 65? Well, this 36,000 is gone. You don't get that back. You paid for your life insurance. You got nothing to show for it. And you cannot keep this times 5 life insurance that you have been paying for after you retire. So now you're 65, the coverage that you've been paying 36,000 for is completely gone. Okay? So if you didn't die during your career, then you just paid 36,000 for nothing. Okay? I mean, obviously you recovered, which is great because everybody needs to be covered, but at the end you have nothing to show for it if you didn't pass away. So what's the alternative here? How can I not spend $36,000? Well, you can save it. Okay, so how about we take that same roundabout number, say $119, and instead of just spending it, why don't we put it into an account and pull it out after we're done working? In exchange, the company will cover you with life insurance. Sounds too good to be true, doesn't it? So, same scenario here. 35-year-old female non-smoker, and this is for 30 years, and she's going to set aside $119.17 a month. Okay, so you can see right here in the first year, after the first year, she's going to be 36. So this is the starting point, okay? And then at the end, at the 30th year, she's 65. So this is the same 30-year time span that we were looking at, okay? This annual amount here that she's setting aside is $119.17 every single year. So it doesn't go up every 5 years. That's why this is bracketed off every 5 years. So you can see it does not go up every 5 years. You're still setting aside $119 every month. So you're just setting it aside and saving it the same amount every single month. Okay. You can see this amount here is added up. So at the end of year 10, she would have set aside or saved $14,300. At the end of year 30, she would have set aside or saved $42,901.20. So in exchange for her setting all of this money aside, this company covers her for $200,000 of life insurance coverage just for putting this money in the account. So that's the life insurance portion of it. She's covered her entire 30-year period. If anything happens to her, this money goes to the beneficiary just for setting money in an account with this company. Well, what happens if she doesn't die at the end of the 30 years when she turns 65? Well, she gets 100% of her money back. Why? Because she wasn't spending it. She was setting it aside. So let me ask you a question. If you saved $119.17 a month every single month for 30 years and you had life insurance the entire way, and at the end you got every single penny that you ever set aside back, how much money did you pay for the life insurance? Zero. Absolutely zero. And that's not it. Not only does it cover you for life insurance, but it also covers you while you're alive. This is the number one biggie for me specifically. Okay. Everybody knows somebody that's had cancer, heart attack, or stroke issues. Okay. Everybody knows somebody. 55% of women will have, 55% of men will have cancer, according to the CDC, 33% of women. So regardless of if you pass away or not, if you ever have cancer, heart attack, stroke, ALS, renal failure, you can read just kind of some of the critical illnesses there. You get the entire $200,000 sent to you, even if you don't die. So again, just to reiterate, if you ever have any critical illnesses that were just listed there, paralysis, blindness, anything like that, then they go ahead and give you the $200,000 death benefit. How crazy is that? Okay. And again, this is absolutely no cost because you're not spending anything. You're just setting it aside and you're getting it all back if you don't die. So that's huge, okay? Not only that, but you can add on some additional stuff. You can cover your children, you can cover your spouse. You can also have it too if you pass away at any point in time during your career. Not only will your family get the initial $200,000 of coverage, okay? But you can also have it pay out, let's say $2,000 a month for 3 years after you pass away as well. That way they have money coming in every month to pay off the bills. Also, this plan is very flexible. She just so happened to want to keep around the same amount that she was spending, and instead of spending it, she wanted to set it aside and have this free coverage. So we just kept it right around the same amount. But if you wanted to set aside $200 a month, well, then the death benefit in exchange for you setting aside that money in the account is going to go up. If you only want to, let's say, save $70 a month in an account with them, well, then the death benefit will not be 200,000, will be a little bit lower. Regardless, it's flexible. That's the whole point. So now you understand and you can see the tremendous value in this. What do you have to do to qualify? It's very simple. It's a really easy qualification over the phone, and you cannot have any kind of critical illnesses in the last typical 6 to 7 years, depending on what state you are in. And I'm talking cancer, heart attack, major stuff, organ failure, no dialysis, absolutely. Minor stuff like diabetes, high blood pressure, cholesterol. Nobody cares about that. It's just the severe stuff. Okay. So as long as you haven't had any of that severe stuff go on in the last 6 to 7 years, again, depending on which state you are in, then you can qualify for this coverage and stop spending money and actually start setting it aside, because this 42,000 is going to come back to you in a tax-free check that's going to obviously assist you, in your retirement. And you're going to be happy to know that you never spent a dime for life insurance. You got it all for free. So that's that. Now we're going to be moving into plus 59-year-olds for your TSP rollovers and how you can, how that's going to benefit you.